Hello everybody. In the current affairs this week, the week ended 30th of June 2024. All these years, all of us who have been looking at the stock markets, especially the Indian stock market, we have seen that in all the bull market or all the rallies which have happened in the Indian stock market, the first entrants in the Indian stock markets were smart investors and especially the FIIs, the foreign institutional investors. They used to propel the rally in the large cap stocks. And then at the fag end of the rally, the mid cap and the small cap stocks would pick up and the rally would start in the mid cap and the small cap segment. This time, in this rally on the Indian stock market, the trend is completely reverse. The rally on the Indian stock market is fueled by domestic money, and the parts of the market which performed the best were the mid cap and the small cap segment. And it is very interesting to note that of the top 20 economies in the world, one of the best performing benchmarks on the last 1 year basis have been the Nifty mid cap and Nifty small cap. Across the world, top 20 economies, the best performing markets or best performing segments of the markets, I repeat, has been the Nifty mid cap and the Nifty small cap. It is now, after the rally in mid cap and small cap segment, the large caps have started rallying. This week, the large cap, the Nifty 50 was up by more than 2%, and Nifty mid cap and small cap both were just up by less than 0.5%. This week, the FIIs bought Indian stocks to the extent of more than 14,000 crores, and DIIs continued their buying at more than 4,000 crores. There is also a sector rotation that is happening in the Indian stock market. Nifty IT and Nifty oil and gas were up by around 3% each. Nifty metal and Nifty realty were down by around 2% each. As far as the global commodity markets are concerned, the trend was lackluster. Crude was up by more than 1%. Gold and silver were down by around 1% each. The trend in the US equity market was also completely unmoved. The Nasdaq and the S&P 500 were just standstill at the benchmark level. One of the important news insofar as India is concerned, which triggered this week, starting from 28th of June 2024, India is now a part of JP Morgan Emerging Market Bond Index. This, from 28th of June, the exposure in this benchmark of Indian bonds would be to the extent of 1%, and it would be scaled up 1% each every month till March 2025, and it will scale up ultimately at 10%. Then another bond benchmark is Bloomberg Emerging Market Local Currency Bond Index. There also, from January 31st, 2025, the Indian bonds are going to have a weightage of 10%. The impact of this weightage would be that there are so many passive global debt funds which follow and mirror these benchmarks. So the moment a bond of a particular country is a part of this benchmark, all these funds have to have an exposure into this country to that extent because they are mirroring that benchmark. So it is expected that India would have an inflow of foreign funds into its bond to the extent of 35 billion US dollars in coming 1 year. It is said that out of which at least $10 billion have already been added before this inclusion, because this inclusion was announced earlier. It has triggered from 28th of June. So we are already having more than $10 billion of funds by way of investments into Indian bonds. The impact of this would be that the interest rates, the interest cost in India would decline, because there would be a larger amount of funds which would be there to buy Indian bonds. So the interest rates on the Indian bonds would definitely soften down, and that would impact the cost of borrowings of the government, which will help the government in its own cost control. At the same time, the moment the cost of borrowing for the government falls, it would also have an impact on the cost of borrowings by the Indian corporates. That can shore up the profitability of Indian corporates. And the third and the most important thing is that there is going to be a flow of this amount of money by way of foreign currency in India. That will also help boost, this capital flows will also help boost the currency equation as far as India is concerned. So this is definitely a welcome and good news for India. We always discuss that the quality of governance, the approach of the government, the significance of democracy insofar as India is concerned are the major plus points of India. This week I wanted to talk in brief as to how, if these things, the approach of the government and the democratic setup in the country, if they are not there, how it can impact the country in a negative way. The case in point is China. In 2014, Alibaba got itself listed in the US stock markets, and they were able to raise 25 billion US dollars. Just one company was able to raise 25 billion US dollars. Because of the approach of the Chinese government, the relationships it has globally now, and its approach and the way it has been treating its large businesses, big businesses, the entire picture has now changed. This year, till date, the amount of monies raised by all the Chinese companies together from the US is just $500 million. This is in contrast of 25 billion raised in 2014 by just one company. So this is the way things can go wrong if the government is in a different mood in treating business and keeping its relations with the world at large. This is all for this week. Thank you.